Good morning, everyone. It's great to be here to share some of the key proposals that came out of Tuesday night's federal budget that might impact you regarding tax, superannuation, and also retirement. It's important to mention, I think, that as with all budget proposals, what we are covering today are proposals only at this stage, and they'll need to be legislated to take effect. And so, we may see some things get legislated, some things not, and there may be some changes to what we're covering today as they make their way through Parliament. As was mentioned, please, if you do have a question on anything that we're covering, type it into the chat function. And once we're done with the content, I'll then endeavour to answer all questions that have been raised. So the centrepiece of Tuesday night's budget was a proposal for 7 years of personal income tax cuts with immediate relief for low and middle income earners from 1 July this year, while higher income earners benefit from later cuts, particularly towards the end of that 7-year period, when one of the marginal tax rates, the tax system is proposed to be simplified, and one of those marginal tax rates is due to be removed. From a superannuation perspective, if you're recently retired and aged 65 to 74 and your super balance is fairly modest, the normal work test that applies in order to make voluntary super contributions, there'll be an exemption for that, which we'll look at. And that might allow you at retirement to contribute more than you otherwise would. Some opt-out insurance arrangements will become opt-in, particularly if you're younger or you've got a fairly small superannuation balance or you're inactive. If you've got a self-managed super fund, the rules are changing, and at the moment you can have a maximum of 4 members. That's proposed to be increased up to 6 members. And so that might allow your fund to have more flexibility, but that does increase the potential issues and risks in your fund, which we'll look at quickly as well. From a, retirement and post-retirement perspective, there's increased spending from the government on a range of aged care initiatives, in particular, more support for certain home care packages. And so that's about allowing older Australians to remain in their home as an alternative to potentially residential aged care. Certain income streams from a social security perspective, where you're receiving the age pension, for example, and assets and an income test will apply to determine your level of age pension, for example. The treatment of certain income streams is proposed to change under both of those tests. There's also changes to what's known as the work bonus, and this is an incentive when you reach age pension age to continue working, and some of that employment income won't count for Centrelink purposes, for age pension purposes, income test purposes. And so that's going to be extended and also expanded for if you're self-employed rather than an employee, you'll also be able to take advantage of that for the first time. And also what's known as the pension loan scheme. And this is essentially a loan scheme allowing you to borrow against your home. It's provided by Centrelink, essentially a voluntary mortgage provided by Centrelink, which you can use to top up your income if you're age pension age. It's going to be expanded as well and made available to more people. So firstly, onto the 7-year tax plan, which I mentioned to start with. And I'm not going to go through every single number on this page. I've got a few graphs to show you, which I think demonstrate the impact of these proposed tax changes in a better way. But I guess the important point that I wanted to make on this slide is there's 3 separate sets of tax changes proposed. One starting from 1 July this year. And as we can see there, one of the income tax thresholds is increasing, and a completely new tax offset has been made available that you may have access to through completing your tax return. In 2022-23, there's the second stage of this tax plan, increasing 2 income tax thresholds, as you can see there, and also replacing that first tax offset I talked about with an increased existing tax offset. The final stage of the plan, 2024-25, is really where we see the simplification of the tax rules, and at the moment there's 4 different tax brackets that's proposed to be replaced by 3 tax brackets, and essentially anyone earning up to $200,000 under that proposal won't pay more than 32.5% marginal tax. This graph just shows over the 7-year period, that should be, the changes to those tax brackets. So we can see there that the blue, you've got your income along the vertical axis there. The blue represents the amount you can earn without having to pay tax. The green is a 19% tax rate, purple 32.5%, and the maroon is 37%. Anything above these columns that you can see there is 45%. So as we can see there, at the moment, there's the 4 tax brackets. Once you get to $180,000 a year, you're then paying 45% tax on anything above that. Once we get through to 24-25, we can see there that's been replaced by 3. And really anyone earning between $41,000 and $200,000, that income is going to be taxed at 32.5%. So a much simpler tax scale, where many people are going to pay a lower amount of tax as a result. I just wanted to highlight the potential tax offset that might apply to you from 1 July this year. And we've got 3 lines on this chart. The amount of offset is on the vertical axis, and your level of income is on the horizontal axis. Now the blue line is what's known as the low income tax offset. That's an existing tax offset that applies at the moment. What's being added is the very similarly named low and middle income tax offset, and that's the purple line there. So that's being added, but the top line, so the black line there, that is just both of those offsets combined. So what we can see there is that we've got a combined tax offset of a bit over $600 right through until almost $40,000 worth of income. It then goes up a bit as your income rises to a bit over $800, and then drops back down to a bit over $500. And then once your income exceeds $90,000, that's when it starts to go down, including to nil. So it's fair to say that as a result of the introduction of this new offset, many of you will get a higher overall tax offset as a result. And just to explain a bit more about what impact a tax offset has, it can't be refunded to you generally, but it is pretty much a direct reduction in the amount of tax that you would otherwise have to pay. So when we're talking here about the combined tax offset being about $650 for lower income earners, that is a direct reduction of $650 in the amount of tax that you're required to pay. I won't go through the explanation in great detail again, but this is how the system of tax offsets will change in that second stage of the tax changes. So that new offset will be gone again, and we'll just be left with the low income tax offset. And as we can see there, it's going to be about $645 for anyone earning up to almost $40,000. It will then drop off quite quickly as income increases. And you'll get some offset as long as your taxable income is below almost $67,000. And again, a direct reduction in the amount of tax that you're required to pay. The next couple of slides that I wanted to look at was how much tax are you likely to save as a result of these proposed tax changes for your given level of income? And we do that in a number of stages. So we've got the first stage first, so that's 1 July this year. This graph is showing the tax saving for your given level of income as a result of phase 1 of these tax changes. So we can see that from 1 July, lower income earners will benefit by at least $200. Many will benefit by the amount of that new tax offset that I was mentioning, so the $530 that we talked about before. While if you're earning $90,000, you get the best result out of this first round of tax cuts. You're going to get a $665 annual saving as a result. For higher income earners, the result of these first set of tax changes is very modest, and really anyone earning $125,000 or over, you get a huge $135 per annum tax saving as a result of the first set of changes. The graph now shows the combined first and second amount of tax cuts as a result of the first 2 sets of tax cuts. So the blue sections that we can see there is that first round that we were just discussing. The purple segments of the bars are adding in that second amount of tax saving. So we can see there that for low and middle income earners, there really isn't a great deal of extra benefit in this second round of tax cuts. But the big impact here is the increase in one of the income thresholds for the 32.5% marginal tax rate. It's going up from $90,000 to $120,000. What does that mean if you're on a relatively higher income? It means that if you're earning $120,000 or over, then you're going to get a benefit, a tax cut of about $1,900 per annum as a result of these further changes. And then finally, we need to add in the impact of the final set of tax cuts in 24-25. And again, the blue segments are the impact of the first changes, the pink segments are the impact of the second round of changes, and the purple are the impact of the third round of changes. Anyone earning over $120,000 a year, again, receives a further tax benefit. And it's really people earning, and that's due to the simplification of the system. And anyone earning $200,000 or over receives an extra $5,200 per annum tax cut, and that takes their total tax cut from these changes for anyone earning that level of income or over to about $7,200 every year. So if I were to sum up those, that's really the impact of the proposed personal tax cuts. And if I were to sum up the impact of those, it provides sort of immediate modest tax relief for low and middle income earners. Middle and higher income earners are going to benefit more substantially, but particularly in phase 3 of those tax cuts, which doesn't occur until 2024. So that's really what I wanted to cover from a tax perspective. I would just mention as well that if you're running a business and you're an eligible small business owner, there are depreciation rules or the ability to claim a deduction for eligible assets worth up to $20,000. Now, you may be familiar with those rules because they've been in place for some time, and I just wanted to point out that they have been extended for a further 12 months. And what that means is if you're an eligible small business owner, you can purchase eligible assets worth, as long as they're worth less than $20,000, you get to immediately write those off from a tax perspective in the year that they're purchased. So the ability to do that's been extended by more than 12 months, but certainly something that eligible small business owners can look to take advantage of. Moving on to superannuation now, and I think a really useful proposal, firstly, an exemption from the normal work test that applies to super. This isn't proposed to kick in until 1 July next year, But the problem that we normally face is that as we reach retirement, if we're aged 65 to 74 on a particular day, then if we want to make voluntary contributions to super, we've got to meet a part-time work test. And that pretty much says that during the financial year, you've got to have worked 40 hours in a 30-day period. If you don't, then mandatory super guarantee contributions can be made, but you can't make voluntary contributions. What this proposed exemption will say is that if your total super balance is less than $300,000 and you're aged 65 to 74 and you met the work test last year, but you didn't meet it this year, so you're a recent retiree, I guess you would say, then you'll get an exemption and you can still make the normal level of contributions in this financial year. Once that measure kicks in. So this is going to be handy for recent retirees with super balances less than $300,000. It will potentially allow you to make an extra, depending on your situation, $125,000 to super that you otherwise wouldn't have access to. So certainly something to keep an eye out for if you're at the stage where you're going to be retiring in the near future. There's also some a measure if you are earning more than $263,157 from employment, but you've got multiple employers, then it's possible for you to, just with your employer's compulsory contributions, which is super guarantee, there's a cap on the amount of tax effective contributions that can be made for you each year. It's $25,000 at the moment. It's possible where you've got multiple employers for that cap to be breached just with your compulsory employer contributions alone. And so what this proposed change is about allowing from 1 July this year is that if that's going to happen to you, if you earn more than that and you've got multiple employers, you'll be able to make an election that anything that would be above your cap doesn't have to be a compulsory employer contribution. And that may allow, if you're in that situation, for you to negotiate with your employer to potentially, swap those super contributions that don't need to be made anymore for other benefits, such as a higher level of employment income. And then finally, tax deductions for personal super contributions. The budget measure is really confirming that the tax office in your income tax return is going to start asking you to confirm that you've met all of the eligibility requirements when you make personal tax deductible contributions. Now, I didn't want to go into great detail about this proposal, but I did want to make the point that where you want to make personal contributions to super and claim a tax deduction for those, and in recent years, being able to do that used to be really limited to substantially self-employed people. That's no longer the case. Employees can also do this now. It is really important when you're making those contributions to submit a deduction notice, as it's known, to your fund, and your fund's got to acknowledge that. But that has to be made within certain quite strict timeframes. And so it's important to comply with those timeframes. And it's fair to say that the ATO is going to be scrutinising that process more closely in the future. And so submitting that notice within those timeframes is going to be very important. And it's really doing that allows you to claim that tax deduction for those contributions in your tax return. Just a reminder to send any questions through as they arise, whether it's about the tax changes that we covered or the super changes. Some more superannuation changes to cover now. And the first is in relation to default insurance. So currently, depending on your fund, you might be provided with insurance, with automatic insurance in your super fund on an opt-out basis. And the government has proposed, in order to protect the retirement savings of young people and those with low balances, and also people who are not necessarily engaged with their superannuation, insurance from 1 July 2019 is going to be changed to an opt-in basis. rather than opt out for people under 25, those with super balances under $6,000. And that includes people who, might have just started saving through that particular fund, but you haven't rolled money in from another fund. Your balance could be below that $6,000 threshold. And also inactive accounts where contributions haven't been made in the last 13 months. There's no, this is going to apply to all people impacted by that. So it's not that if you've got existing insurance in place, that's fine. So if you're going to be impacted, you're going to have essentially 14 months through to 1 July 2019 to decide whether you want to opt into that insurance or whether you're happy to let that insurance lapse. For people not covered by those scenarios that I've just outlined, there's no change to how insurance works within super. There are some changes to superannuation fees that you can see there. I won't go through those in great detail, but it is about banning exit fees, the proposal, and also capping fees where your balance is less than $6,000. There'll also be some further streamlining of super consolidation. So the ATO will be able to, at the moment, certain accounts of low balance members go through to the ATO. That will be expanded, and the ATO is also going to be taking more action to try and, if you've got a small balance which is sitting with them, to try and find your active account and put that amount into your active account. So the account you're contributing to, for example. And then finally on superannuation, there are two things in the budget for if you have or you're thinking about a self-managed superannuation fund. The first is that the maximum membership, which is 4 at the moment, and this applies from 1 July 19, is increasing that 4 maximum members to 6 members. It's important to note, firstly, that I think this is going to apply to a relatively small number of SMSFs, because if you look at the statistics, it's really only 3.7% of SMSFs that even have that maximum number of members at the moment anyway. The vast majority of SMSFs have 1 or 2 members, with a 2-member fund being by far the most common. But I think this announcement will allow more flexibility for larger families to structure themselves into a single fund. So you might have 2 parents and 4 children, for example. Under this proposal, you'll all be able to be in the same fund. And so more flexibility, it will give you a potentially larger pool of assets to have in your fund, which might make additional investments available. It might lower cost, etc. But it is also important, if you're considering an increase in the number of members, to consider the increased risks and issues associated with that larger membership. So there could be, you might have members of very different ages that have very different investment needs. So you might have to have multiple investment approaches in the same fund. There may be additional administrative penalties where things go wrong and more administrative changes required because you might have members leaving and joining the fund. And there is the increased risk of disputes between the trustees. You've now got 6 people running the fund rather than a maximum of 4. The potential for things to go wrong or for disputes to arise have increased. And then finally, just highlighting that at the moment, if you've got an SMSF, you've normally got to get it audited every year. Well-behaved SMSFs are going to have access to a 3-year audit process instead. So that's where your previous audits are good, you've been lodging your annual returns in a timely manner. The ATO will reduce the requirements for your audits to 3 years. And then finishing off with the retirement changes, and the first is new asset and income testing rules for lifetime income streams from 1 July 2019. So at the moment, the way lifetime income streams count for assets and income test purposes, and this is the assets and income tests are used to work out your rate of age pension, for example. The assets test the value of a lifetime pension or annuity that counts goes down from your purchase price to nil normally by the time you reach your life expectancy. The proposed change here is just to count 60% of the purchase price for a certain period of time through to age 84 normally, and then 30%. So there's a bit of a change in treatment there. And it also changes under the income test. So at the moment, your pension payments that are being received, less a certain return of capital will count. From 1 July 2019, it's going to be 60%, like a flat percentage amount. So this is the change which is proposed to occur, and it might lead to very different assets and income test amounts as a result of these new rules. It could be better or worse depending on your particular situation. But the other important point is that if you start a lifetime income stream, an eligible lifetime income stream prior to the day of that change, 1 July 2019, existing rules will continue to apply. So if you're thinking about a lifetime income stream and retiring around that 1 July 2019 date, it's going to be important to think about what set of rules you want to be counted under to determine when you're going to start that lifetime income stream. So if that applies to your situation, it's going to be very important to get advice about the right decision in those. Just to highlight very quickly, there's increased funding for both home care and aged care. So there's significant demand for home care at the moment. The government's funding an additional 14,000 places. There's also more funding from 1 July 2019 for a range of different aged care initiatives. And just to finish off before we open it up and see if anyone is keen to ask a question, feel free to send those through at the moment. Firstly, the work bonus change, and both of these last changes that I wanted to cover apply from 1 July next year. So at the moment, the work bonus allows you, if you've reached age pension age, and this is really about encouraging people who've reached age pension age to keep working. At the moment, if I'm age pension age and I do go out and work as an employee, the first $250 per fortnight of my employment income doesn't count for income test purposes. So I can earn a bit of income with knowing that it's not going to affect my age pension. I can also accrue, if I've got unused amounts of that $250, I can accrue up to $6,500 worth of those exempt amounts. And that's really handy for people who might do, work a bit and then have a bit of time off and then work a bit, exam marking, seasonal workers, that sort of thing. Both of those measures are proposed to be increased to provide additional incentive for working. So the $250 per fortnight becomes $300 per fortnight. The $6,500 of accrual that you can get becomes $7,800. So more incentive. The other thing is it's being extended to cover not just employees, but self-employed people as well. So it doesn't cover passive income. There'll be a test introduced. But if you are age pension age and you're running a business, then the first $300 per fortnight of that business income is also not going to count for income test purposes. So a real win, I think, going forward for people in that situation. And then finally, I'm not going to go into great detail about the pension loan scheme because it does get quite complicated, but it's essentially a voluntary reverse mortgage provided by Centrelink. And what does it allow? It allows potentially, at the moment, you can get potentially up to the maximum rate of age pension as top-up income to support your Social Security payments and give you a bit of extra retirement income. That 100% is being increased to 150%. So it is going to mean people can get a high level of top-up retirement income. Now, it's not always 150%. It's the amount that you can get yourself is going to depend on a range of factors like age, level of Social Security income at the moment, how long you want the payments for, the value of your home. But it could potentially allow people on the maximum age pension to top up their income by about $12,000 for singles or $18,000 for couples. So for people in that situation, it might allow them to essentially use their homes to have a greater standard of retirement income going forward. So I think that's all of the slides that I wanted to cover, but happy to open it up if anyone wanted to type any questions in that they had. Happy to take any questions either on the tax changes, the super measures, or the retirement measures that we just covered. So we've just opened it up for questions a bit, but we haven't had any come through. So yeah, if there's no other questions that anyone had, I'd just like to thank you very much for your participation today. It's been great to come and share some of the measures from Tuesday night's budget. And just to probably finish off by highlighting again some of those key things to be aware of out of this budget. So the 3 tranches of personal income tax cuts proposed, low and middle income earners benefiting straight away, higher income earners benefiting more substantially, but further into the future. That exemption from the work test at retirement for superannuation, I think, is going to be really important, potentially allowing you, if you've recently retired, to get an extra amount of super contributions into the superannuation system. And then those last changes that I covered in relation to retirement. So the Centrelink work bonus is really going to allow further employment income and self-employment income to not count, and so there'll be incentive to continue to work once you reach age pension age, knowing that it's not going to have a big impact on your age pension. And then finally, that pension loan scheme, the ability, particularly for full pensioners, if you're receiving the full age pension where you couldn't previously take advantage of this, you might be able to top up your income going forward using the pension loan scheme. So they're probably the key things. Thanks very much again for your participation, and have a great day.